when a flood or fire hits your home, one of the first questions a lot of people ask is, how am I going to pay for this, right? Well, the tax tips that you need to know in order for you to come out on top. Thousands of people now preparing for potential disaster. And when disaster hits, you know, we know that it could mean some big money out of your pocket. So how do you kind of ease some of that loss? Well, we've got Bob Hockensmith here, CPA superstar, and we appreciate you being here to kind of walk us through some of this here. So what qualifies someone, this is what we want to talk about, for casualty loss deductions?
There's a lot of things that qualify for it, and a lot of people don't know this. For instance, a fire, a flood, an earthquake, a hurricane, an auto wreck, a break-in in your home. A lot of people don't understand that. That actually qualifies as a casualty loss as well.
Okay, so what qualifications do we have to meet in order to get that?
In order to get your casualty loss deduction, you actually have to lose something that you paid money for, number one. Number two, you have to not have been reimbursed by your insurance company. So you take whatever you spent for your item, subtract your insurance reimbursement, the difference is your loss. Now that loss is what you could take off your tax return, and the benefit with the IRS is you have a loss in 2017, a casualty loss in 2017, you can actually go backwards 2 years into 15 and 16, amend your tax return right now, and get some money back for that loss that occurred today.
Okay, so what, I guess I'm trying to think, you would think that you would want the insurance to pay you out for that, right? So what might be the benefit, or why might somebody choose to do that versus going through the insurance?
There are a lot of people that don't have a lot of insurance. There are a lot of people that don't have enough insurance. And frequently, insurance doesn't reimburse 100% of your loss. They, depreciate items. And so if you purchased maybe something for $10,000, you might find that today the insurance company gives you $3,000. That's a $7,000 loss net. That is what you might be able to use off your tax return.
Okay, so let me ask you this. What if the loss actually exceeds, this?
If the loss exceeds the amount of the income that you reported on your tax return, which it does happen sometimes, especially these hurricane situations, you could actually get all your money back that you paid to the IRS. You can take that loss that's extra, whatever you didn't use, and carry it forward into future years. When Bernie Madoff stole all that money from people in 2008, right? A lot of people were able to take that loss, carry it backwards into 2006, take a tax deduction, and that ate up all their income for 6, 7, and 8, and then they carried it forward for 4 or 5 years and didn't pay taxes for 4 or 5 years.
Wow. So does this surprise a lot of your clients?
Oh, it does. Yeah. I have all the time. I have people say, I had a car wreck, or I had a break-in at the house, or I had a big flood at the house, and I'll say, oh, well, let's take a look at it and see if we can write it off. And they go, what? You can write that off?
You're like, yes, you can. There you go. Bob, thank you so much. So important, especially when we're looking at Hurricane Irma and all of that damage, and we're still in monsoon as well. So we can't forget that. Bob, if people would like to know more about what you do and how to reach you, where
they can go to azmoneyguide.com. That's azmoneyguide.com, or 602-264-9331.
All right, Bob, thank you so much. We always appreciate when you make time for us. Thank you. Guys, we'll be back.